In the autumn of 1929, Wall Street shimmered like the center of the universe. The stock tickers clicked without rest, fortunes were made overnight, and every headline promised a new age of endless prosperity. To the average American, it felt like the world had finally learned how to get rich forever. But behind the champagne toasts and the glowing optimism, a very different kind of movement was already underway. The smart money, the Kennedys, the Baruchs, the Livermores, were quietly packing their bags. They weren't listening to the cheers from the trading floors. They were listening to the silence between them. These men had seen it before. The feverish optimism, the borrowed millions, the blindness that comes right before the fall. While newspapers called it the American dream, they called it what it really was, a bubble fattened by debt and greed. And when bubbles burst, they don't whisper, they roar. As October 1929 approached, the cracks in America's financial empire were widening, invisible to most but glaringly obvious to those who knew how to read the signs. The question was never if the crash would come. The only question was who would get out before it did. Because when history repeats, it doesn't forgive those who sleep through its warnings. The 1920s were a decade of noise, speed, and illusions. America had just emerged victorious from World War I, and with the trauma of the trenches behind them, people were desperate to live, to spend, to believe. The country was flooded with new inventions, radios, automobiles, refrigerators, and the electrifying promise of modern life. The rhythm of jazz pulsed through the streets, skyscrapers rose like monuments to ambition, and Wall Street became the beating heart of the American dream. Everyone wanted a piece of it. The idea that money could multiply endlessly took hold of the national imagination. Stock prices doubled, then tripled. Companies like General Motors, RCA, and US Steel became household names, not because people used their products, but because they owned their shares. For the first time in history, ordinary citizens, secretaries, teachers, even farmers, were borrowing money to buy stocks. They called it buying on margin. For every $10 they had, they could borrow $90 more, a bet that prices would keep rising. And for a while, they did. Every success story fueled another. Newspapers printed tales of cab drivers turned millionaires. Shoeshine boys bragged about their stock tips. Bankers lent freely, believing the boom would never end. The euphoria was intoxicating. Economists spoke of a permanent prosperity. Politicians claimed that recessions were a relic of the past. America was drunk on confidence. Yet, beneath the glittering surface, a different story was being written in quieter rooms. The same optimism that built fortunes was also building fragility. With so much borrowed money floating through the system, even a small tremor could shake the entire structure. Leverage had replaced logic, and greed had replaced caution. But most people didn't care. As long as prices climbed, they believed nothing could go wrong. The few who warned otherwise were mocked as pessimists. Why sell today, they said, when tomorrow's profits are guaranteed? That question would soon answer itself. Because in every era, euphoria always has an expiration date, and in 1929, America's was already stamped. By the start of 1929, the warning signs were flashing like red lights across the financial landscape, yet almost no one wanted to see them. The Federal Reserve, alarmed by the surge of reckless speculation, began quietly tightening credit. Interest rates climbed from 5% to 6%, a clear signal that money was no longer cheap. But on Wall Street, the music was too loud for anyone to notice the conductor slowing the tempo. Brokers assured their clients that the boom was unstoppable. Newspapers kept celebrating record highs. The public was convinced the market had transcended gravity. Only a handful of sharp minds realized that when everyone borrows to buy, the system becomes a ticking bomb. Across the Atlantic, European investors were among the first to lose faith. In London and Berlin, bankers who had once poured money into American stocks began liquidating their positions. They had seen this movie before. What goes up beyond reason, they knew. must come down with equal violence. Throughout September and October 1929, British banks quietly repatriated capital, transferring millions out of U.S. markets while American investors were still buying with borrowed dollars. It was the financial equivalent of rats leaving the ship before anyone else smelled smoke. Meanwhile, inside corporate boardrooms, another kind of exodus was underway. Company insiders, executives who knew the true state of their businesses, started selling their own shares in record quantities. These were not random sales. They were calculated withdrawals. When the men running the companies began cashing out, it spoke louder than any headline. Even more telling, the bond market, that sober mirror of long-term confidence, began to strengthen even as stocks soared. For professionals, this divergence was a warning siren. It meant sophisticated investors were quietly shifting from speculation to safety, trading dreams for discipline. The margin calls were another whisper of the storm ahead. When investors buy stocks on borrowed money, a small dip in prices triggers calls from brokers demanding more cash. In October 1929, those calls became relentless. Brokerage houses were flooded with panicked clients struggling to cover debts they should never have taken on. The professionals saw this as a fatal crack in the foundation. If people were struggling to meet obligations during good times, what would happen when times turned bad? But the public refused to listen. Radio shows still promised fortunes. Politicians still preached optimism. Even as warning after warning appeared, few believed the dream could end. Joseph Kennedy, however, was paying attention. Legend says he decided to exit the market when his shoeshine boy started giving him stock tips. The truth is more complex. Kennedy understood leverage better than most. He knew that debt, once it starts to unwind, becomes a self-feeding fire. Bernard Baruch, a veteran of earlier panics, also began shifting to cash and government bonds. He had survived the panic of 1907, and he recognized the smell of fear long before others did. Both men understood the same unspoken rule of markets. When the crowd thinks it's invincible, the end is near. By late October, the lines were drawn. On one side stood the masses, intoxicated by easy profits, still convinced the good times would never end. On the other side stood the few who had seen this pattern too many times to ignore it again. They were the smart money, watching, waiting, and quietly preparing for the day when the dream would finally collapse under its own weight. In the final months before the crash, 3 men stood apart from the crowd: Joseph P. Kennedy, Bernard Baruch, and Jesse Livermore. They were not prophets. They were realists who understood that markets are ruled by emotion, not reason. While ordinary Americans were hypnotized by the illusion of infinite wealth, these men saw the system for what it truly was: a house of cards built on debt and denial. Their secret wasn't luck, it was discipline. Joseph Kennedy, the patriarch of a family that would later dominate American politics, had made his first fortune in Hollywood and shipbuilding. But by 1929, his sharpest instincts were reserved for finance. He had seen how greed clouded judgment and how fast success turns to panic when the tide shifts. Kennedy began liquidating his holdings early that year, converting paper profits into cash while others doubled down. When asked why he sold, he famously said it was when the shoeshine boy started giving him stock advice. Beneath the joke was a deadly serious principle. When everyone becomes an expert, no one is safe. By October, Kennedy wasn't just out of the market, he was betting against it. He quietly built short positions, wagering that America's unstoppable bull run was about to meet gravity. Bernard Baruch, another titan of the era, had already lived through one financial cataclysm, the Panic of 1907. He had watched men lose everything because they believed markets could defy logic. Baruch's wealth and influence gave him access to information others could only dream of. Through his network of contacts in Washington and Wall Street, he sensed the danger in the air: the frantic trading volumes, the overheated optimism, the obsession with speculation. By the summer of 1929, he had sold most of his holdings and moved heavily into government bonds. When the storm came, Baruch would be one of the few standing on dry ground. Then there was Jesse Livermore, perhaps the most brilliant and feared speculator of his generation. Nicknamed the Boy Plunger, Livermore had made and lost fortunes several times before. But 1929 was different. He had been studying market psychology for months, tracking the manic buying patterns that signaled mass delusion. Unlike Kennedy and Baruch, Livermore didn't just step aside, he set a trap. He began constructing massive short positions, betting that when panic finally struck, the collapse would feed on itself. He understood that margin debt would turn minor losses into forced liquidations, that fear would spread faster than reason, and that the greatest profits are made when everyone else is losing everything. Each man's strategy was different, but their logic was identical. The crowd is always late. They had no illusions about being heroes. They were survivors in a system that punishes complacency. And as October 1929 crept closer, they saw the same pattern forming, the same euphoric blindness that had preceded every crash in history. The signs were everywhere for those who knew how to read them. Corporate insiders selling, bond prices rising, foreign money fleeing. The puzzle pieces were falling into place. While most Americans slept peacefully, believing the dream would last forever, Kennedy, Baruch, and Livermore were awake, calculating, and waiting. They didn't just expect disaster, they were engineering their escape from it. For them, the coming crash was not a tragedy, it was an opportunity, and when the first domino fell, they would already be standing on the other side. In the final days of October 1929, the tension on Wall Street was electric. Behind the polished marble walls of brokerage houses, panic was beginning to whisper. The market had shown cracks for weeks, but on Monday, October 28th, the illusion finally started to unravel. The opening bell rang to a wave of selling unlike anything the exchange had seen before. Stock prices plunged within minutes, and the ticker tape lagged so far behind that no one knew the true numbers until it was already too late. To most investors, it looked like a storm out of nowhere. But to the smart money, it was the moment they had been waiting for. Across Long Island and Newport, private phone lines lit up. Wealthy families who had built fortunes during the boom were now liquidating everything they could. In the smoky dining rooms of Manhattan's elite clubs, frantic conversations replaced laughter. This wasn't panic, it was execution. For months, these men had been preparing contingency plans, short positions, and escape routes. They weren't watching the collapse in horror, they were orchestrating it with precision. While ordinary investors called their brokers in desperation, the Kennedy family's advisors and Baruch's contacts were already converting positions into cash or profitable shorts. At the same time, European banks were making their final move. From London, Paris, and Berlin, a steady stream of telegrams crossed the Atlantic carrying sell orders. The British merchant banks, which had quietly withdrawn capital weeks earlier, now dumped their remaining American holdings at any price. It was a global retreat, one that confirmed what the insiders already knew. Confidence in the U.S. market had collapsed. Even foreign central banks had begun hoarding gold, abandoning the once unshakable U.S. dollar. Inside corporate boardrooms, executives faced their own reckoning. Many had been granted stock options that were worth millions on paper. Now those fortunes were evaporating by the hour. Desperate to preserve what they could, company insiders dumped shares at record speed, even as they publicly assured investors that the fundamentals are sound. Hypocrisy had become survival. Meanwhile, the Federal Reserve was paralyzed by division. Some officials urged immediate action to stabilize credit. Others argued that speculation needed to be purged, no matter the cost. While they debated, the market continued to burn. Interest rates remained high, and liquidity was vanishing from the system. The small investors, those who had borrowed everything to chase the dream, were being crushed by margin calls they could no longer pay. Brokers sold their stocks automatically, triggering even steeper declines. As the chaos deepened, Jesse Livermore sat in his private office, surrounded by ringing telephones and ticking ticker tape. His short positions were paying off spectacularly, but he watched the carnage with icy detachment. To him, This was the inevitable mathematics of human greed. Each wave of forced selling drove prices lower, which created more margin calls, which created more forced selling. It was a spiral no one could stop. By nightfall, the atmosphere in New York City had changed entirely. The champagne bars were silent. Bankers walked the streets in disbelief. The market had dropped 12.8% in a single day, erasing billions in paper wealth. But for those who had prepared, Kennedy, Baruch, Livermore, it was a triumph of foresight. They had not just escaped the collapse, they had profited from it. And yet, as they watched the panic spread from Wall Street to Main Street, even they must have sensed that the damage was far from over. Because the next morning, Tuesday, October 29th, Black Tuesday, would make everything that happened before look like a rehearsal. When the sun rose on October 29th, 1929, New York woke to chaos. Crowds gathered outside the New York Stock Exchange, their faces pale with disbelief. Inside, the opening bell triggered a detonation that echoed around the world. Within minutes, 16 million shares flooded the market, an avalanche of selling unlike anything in financial history. Prices collapsed before traders could even write them down. But this was not random panic. It was, in many ways, a controlled demolition, the final act of a drama that had been quietly scripted by those who knew how to play the system. The smart money moved with ruthless efficiency. They didn't rely on the clogged phone lines or public telegraphs. They had private communication channels, dedicated telegraph wires, and even messenger runners operating across Wall Street. While ordinary investors waited hours to reach their brokers, the insiders executed trades instantly. They had designed this infrastructure precisely for moments like this, a network built for survival in a storm. Jesse Livermore, operating from his private suite, watched his short positions explode in value. His profits soared past $100 million, a staggering sum that would equal over $1.7 billion today. His calm contrasted sharply with the hysteria outside, where investors screamed, wept, or fainted as their life savings vanished. The collapse spread through sectors like fire through dry timber. Banks were the first to fall, weighed down by loans they had made against collapsing stock portfolios. Investment trusts, the speculative funds of the 1920s, faced a death spiral. They had borrowed enormous sums to buy stocks, often using those same stocks as collateral. As prices plunged, margin calls forced them to sell more, which pushed prices even lower, a vicious cycle of destruction. By noon, blue-chip companies that once symbolized American strength, General Electric, U.S., Steel, Radio Corporation of America, had lost half their value. The market was not merely correcting itself, it was devouring itself. Every sell order fed the next. Every margin call became a trigger for another wave of panic. To the smart money, this was the moment they had engineered months ago, the cleansing fire that would separate the wise from the blind. Joseph Kennedy closed his final short positions as the market bottomed out, then quietly began buying select blue-chip stocks at rock-bottom prices. His fortune, born from panic, would soon fund a political dynasty. For the rest of America, it was devastation. Banks shut their doors. Families lost their homes. People who had believed in the dream of endless prosperity now lined up outside soup kitchens. But for a select few, the crash was not a tragedy, it was vindication. They had read the signs, trusted the math, and moved before the herd. In their eyes, this was not betrayal, it was survival. The controlled demolition of 1929 was more than an economic event. It was a turning point in human psychology. It proved that when greed outpaces wisdom, collapse is not an accident, it's a law of nature. And those who understand that law always walk away richer than those who deny it. When the dust finally settled after Black Tuesday, the world looked unrecognizable. In just 2 days, the Dow Jones Industrial Average had lost nearly 25% of its value. Within months, over $30 billion in market wealth, more than the entire US federal budget, had vanished. The crash did not just destroy money, it destroyed faith. The glittering illusion of the Roaring '20s gave way to silence, hunger, and despair. Across America, factories closed, banks failed, and families who had once believed in endless growth now stood in breadlines that stretched for blocks. The Great Depression had begun. The human cost was staggering. By 1933, unemployment had soared above 25%. Thousands of small banks collapsed, wiping out the savings of ordinary Americans. Farmers lost their land, investors lost their homes, and hope itself became a luxury. Yet amid the wreckage, a handful of men emerged wealthier than ever. Joseph Kennedy, who had escaped the crash unscathed, and in fact richer, used his fortune to reshape his family's destiny. He invested in real estate, shipping, and Hollywood, and within a decade, his son, John F. Kennedy, would begin a political rise that led to the White House. For Kennedy, the lesson of 1929 was eternal. Only a fool waits for the crowd to act. Bernard Baruch became one of the most trusted advisors to presidents, counseling Franklin D. Roosevelt during the Depression. His warnings about speculation helped shape a generation of reform. Jesse Livermore, meanwhile, became the symbol of the paradox of success. He earned a fortune from the crash, over $100 million, but the psychological toll of decades spent battling markets eventually consumed him. In 1940, he took his own life, leaving behind a note that read simply, "I am a failure." Even for those who win, the market exacts a price. Out of the ruins of 1929 came a new world order of finance. Congress passed the Glass-Steagall Act to separate commercial and investment banking. The Securities and Exchange Commission, SEC, was created to enforce transparency and protect investors. The age of unregulated speculation was over, at least in theory. But as history has shown, memory fades faster than greed. Every few decades, new generations convince themselves that this time is different, that the rules no longer apply, that prosperity can rise forever without falling. And yet, the echoes of 1929 remain. The lesson is written not in textbooks, but in blood and bankruptcy. Markets reward preparation, not optimism. For those who understand the rhythm of greed and fear, every boom carries the blueprint of its own collapse. History doesn't repeat exactly, but it always rhymes, and those who ignore its warnings will hear that rhyme too late. History remembers October 1929 as a moment of sudden collapse, but for those who truly understood the game, it was never sudden at all. The smart money had seen it coming for months, maybe years. They didn't need headlines to tell them the party was over. They could hear it in the silence between the cheers, in the way the market trembled beneath its own weight. What happened on Black Tuesday was not chaos. It was choreography, a carefully timed unraveling that punished faith and rewarded foresight. The crash taught one brutal, timeless truth. The market doesn't forgive emotion, only ignorance. It doesn't care about dreams, promises, or hope. It moves to the rhythm of fear and greed, and only those who learn to hear that rhythm survive. The story of 1929 is more than a tale of numbers. It's a mirror. Every boom since then, from the dot-com bubble to the housing crash, has carried the same melody. We always believe it's different. We always think we're smarter. But history has patience, and it always collects its debts. In the end, the smart money walks away not because they're lucky, but because they never forget that when everyone else is buying the dream, that's when it's time to wake up.